I will I will give it a shot. Last time I tried this, it came out in like a 47 word thing and did not open. So I will send it and hopefully it works. Um, but wanted to talk about a few things. Obviously, I'm sure you guys are seeing it too. We're seeing massive escalations early in the year, like we saw in 2024 and also in 2023. And a big part of that too is just how our appreciation kind of cycles through the marketplace in January through June, July, and then we get a little bit, I don't want to say stagnant, but a little bit flat between September and December. So when we see large spikes in, appreciation or offers in January, February, and March, first we want to talk about strategies on how to help our clients feel comfortable doing that early in the year when they might not have to do that in November and they're still looking for a property. I think that's the first thing that we should roundtable a little bit. And the reason for it is we're having those discussions, I think, sometimes before maybe even the realtors do. Like we're doing those in our initial meetings, showing folks what 5% versus 10% over the list price might look like to try and influence them to at least start thinking about it before they're in the process with you guys saying, okay, this is going to go 10% over, and all of a sudden they go, whoa, we don't know how to prepare for this. So it's definitely a team game to start there. We're trying to get folks prepared for those escalations, even when we might not have those conversations as realtors yet. So with that though comes, the season that January, February, first of all, I just want to say we haven't had a big spree of low appraisals, but when you start seeing, 10, 15, 20% escalations, that's always a fear. We had a client just a month ago that got really aggressive with an offer price well above list very shortly after it was listed. And the good news there is we had a really big down payment. So a low appraisal wasn't an issue at all because even if it came in 10 or 12% low, that wouldn't have hurt our loan program. And I think that's always something to note is what kind of client do you have, right? Is it going to impact, if we've got a barely getting by 20% down jumbo client and we have a low appraisal, that's a very different scenario than if you have a 40% down person who's, maybe got 10 or 15% to work with on a potential low appraisal. So I think that's really important. One, that we know what kind of client that we have. What is the ability to get to more assets if needed? Do we have a potential gift from a family member that could step in and help in case of low appraisal? All those different things are really important. But one thing I wanted to share too, and we've talked about this in the past, is when you have a low appraisal and you're in a conventional loan program, which given that the current marketplace in Kingston, Homish, and Pierce County is now 1,035,000, that's a lot of the first time buyers that are going to 1,100,000, 1,200,000 now. And only 2 years ago, that might have been 900. So I always love to share this example. And even though this is a different price point, I think it's great to note what did I show the wrong screen? Sorry, guys. Hang on one sec. Let's see. That's the one I wanted. All right. So this is a case that we've got a $500,000 offer price on a $500,000. Maybe it started at 450 and escalated all the way up to five, which is a pretty large escalation, right? That's about 10%, or really closer to nine. But if we're looking at a $500,000 offer off a 450 price, that could start raising alarm bells in, early in the year, whether it's January or February. My opinion is always if we get close to March, especially early April on a closing, then we've got about 90 days of data points that would support different prices, right? Because prices, as we all know, are different in November, December than already what we've seen in January. So I wanted to illustrate this for everybody. So if we've got a $500,000 offer price and we get into a scenario where, oh no, we've got a low appraisal of 25,000. First of all, these are conversations that all three of us need to have, the realtor, the lender, and the client, that if we're getting aggressive in price or an offer, there is a chance that this happens. Now, luckily in this scenario, this client had 20% down. And I think that's really important to, again, go back to what do we have for a down payment? If you're a 5% buyer, do we have another 5% we can get to if we need to? In this scenario, how we would have set this up with the client is, okay, we're going in at 500 with 20% down. However, if this appraisal comes back $25,000 low, you do not have to change your total cash to close. And in this scenario, what that would amount to is now we only have $75,000 in a down payment amount because $25,000 was used to offset the price due to low appraisal. All we've done in scenario two is restructured the loan to say, hey, we have to base this off of the 475 price, not the $500,000 price. So all we do in this scenario is keep the loan exactly the same, 400 versus 400, and we adjust to add a very nominal amount of mortgage insurance, about $60 a month, in order to keep our cash to close plan 109,945, 109,864 exactly the same. And we can all see all we've really done is increased our monthly payment from 3,062 to 3,118. And I think that's a really important thing that we can go in as lenders and agents and talk to clients like this. And maybe we only write a 15% down offer in this scenario, or maybe we waive financing in the contract so it doesn't even matter. But this is a scenario where we can get a little bit aggressive as long as the client understands the mathematics to it of, okay, I'm still putting 15% down in a scenario where we had a $25,000 low appraisal, and the only thing that changes is I pay $60 more a month. The other thing that we could do there is bring in the additional cash, right? But maybe that client doesn't want to bring an additional, $20,000 to the table in a low appraisal scenario. So this is a way just to adjust the loan using the exact same cash to close, 109 or 110 to round it off and be easy with it. Now, in the case that we've got 50,000 loan appraisal, again, we're going off of the appraised value, and this probably would not happen, right? That's a 10% low appraisal. That's a lot. But in this scenario, let's look at it. It's the same mechanics. We're still bringing the exact same total cash to close at 110 or so thousand dollars. And now our PMI just went up a little bit more because we only have 11% down versus the 15 or the 20. And again, not a huge change, right? 3145 versus 3,062 in this scenario, and we had almost a 10% low appraisal. So this is one way that we can structure with clients to be really aggressive on offers, but feel like we've got a really good backup plan in case of a low appraisal, and we're not changing our cash to close plan. And I think this is something, again, up to like 1.2 now with 20% down that we can use and be aggressive on a potential low appraisal or getting aggressive on escalations. As we all know, that's where the market's kind of taking us right now. Any questions or comments surrounding this setup? Jack, Brooke, I see you guys live. Is that registering on kind of how we make those adjustments? Even a thumbs up, we'll take it. Brooke, you got that one? Cool. Jack, we're good on that one? Sweet. So this is one scenario, you guys, that we're using, and I think it's super important. And because let's look at the differences. This is the exact same setup, but in this scenario, we're bringing extra cash to close. So $400,000 loan amount, $380,000 loan amount, or a $360,000 loan amount. Because remember, we're basing the 20% down off of the new value. So that's why you see loan amounts only changing by 20,000 instead of the 25,000 low appraisal. Because remember, that difference in a low appraisal is off of whatever the new price is. Like 25,000 low doesn't mean you're bringing in exactly 25,000. That would mean in this scenario, the client's bringing 20,000 difference to close because that's the difference in our loan amount. That's what's important when you're looking at low appraisals from the client's perspective. And now this is what I like to reflect too, because 29.25 with an additional 20 grand versus 31.18, we really haven't moved the needle a whole lot on monthly payment. So to me, the option of keeping the same cash to close plan versus bringing in an additional $20,000, it really doesn't move the needle too much on monthly payment, only about $200. So I think that's a strategy we need to try to help clients understand, especially up front. And for you guys to at least understand the mechanics of it, I think it's really important to creating that triangle of trust between all three of us and saying, hey, we do have two options. We can bring in the 20,000, or we can, potentially change the structure of the loan, which in my opinion, this makes way more sense. 20 grand for 200 is a huge change in cash to close. We all know how hard it is to save $20,000. So I think it's really, really important that we all understand that. Yeah, Jack, fire away.
What does it do for the timeline? Because usually by the time we get these appraisals back and all the rest, early part of the year, it takes everybody a while to start whipping it back up before they can, it's still going to take them 7+ days as they get busier and busier. So,
Yeah,
what does that do for you all trying to get it through underwriting again with this?
it's
How easy is this piece to get pushed through?
so simple. And really the program in that scenario doesn't really matter too much because we probably already have a conditional approval by the time that we get an appraisal back in about 7 days. So let's look at that timeline. Let's say like we got a 21-day close on this conventional timeline, or let's say we've got about a 27-day close on a jumbo timeline. We should have this scenario pretty well. First, we'll do it before we submit. So we all know that this might be a backup plan that we go to. And then on about day 8 or 9 of that 21 or 28-day close time frame, we probably have our appraisal back and we already know what the results look like. So if we already know what our results look like, then really we're just making an adjustment either to add an additional 20,000 in cash. In that scenario, we would have to source where that cash came from. So it's very likely already in the account statements that we have. If we're simply adjusting the structure of the loan, we would do that almost automatically. We would do that in one day. So that's not going to change our timelines at all from a closing standpoint. And we probably already had this plan B set up from the start. So as far as changing timelines, we should know within about 10 days or at least within 10 days of close that we need to make a restructure. And we're not changing loan programs. So when you change loan programs, that can take a little bit longer. But when you're just changing structure like this, really, really fast adjustment. Does that answer it, Jack? Cool. Awesome. So again, bring it in. Let's just kind of go through the rigmarole here. So 20,000 for this change, about 40,000 for this change, and again, not really moving the needle too much, even on a $40,000 difference. So we really, and this is still with rates, current rates ±7. So this structure to us makes a ton of sense and gives the flexibility of, maybe we write it with 10% down plus on contract or 15% down plus so we don't have to go back to the seller and get new signatures. I think if we are going with this strategy, it is smart to maybe match it with that contract because we don't want to get out of whack with the sellers. So if we are going to approach this low appraisal option by restructuring, instead of offering with 500,000 with 20% down, maybe it's 500,000 with 15% down because that just built us a 5% low appraisal gap. Or maybe it's 500 with 10% down. And then we communicate with listing agent, hey, we're really doing 20, but we're kind of building in our own 10% down appraisal gap here. And then, a good agent will certainly know that. And if they don't, then I'll just show them the math or at least explain it to them why we're doing it that way. And we've had success that way too. So I think teaming up on that, making sure that our offers are written with this structure in mind is very important. So that's something just to keep note of is if we're not bringing in cash, then maybe we need to make sure our PSAs are dotted accurately. So I think that's a big one here. Any comments or questions around how that structure would work and why we're doing 15% instead of 20 on contract, or is it pretty clear? Thumbs up. We good? Oh, sorry, Debbie. Go. I can't hear Debbie. Can anybody hear Debbie? Sorry, Debbie. I can't hear you. Can we type it in or give me a quick call? Steph, I can't hear your feed. I'm not getting any audio from you guys. Debbie, you want to call me real quick? Or Jack, you want to call me? Jackie?
Hi, I was just telling you to. Oh, anyway, sorry. I was going to say you could move on.
Oh, well, Debbie had a question.
I was just going to make some comments that, frequently we quote 2 weeks for closing. And if an appraisal comes in low, then we will be keenly waiting for that appraisal and we'll immediately reach out to the client. And they will know that they have options for restructures or to bring in the extra cash, right? Kind of speaking to Jack's concern, So everything will happen very quickly. We will not miss a beat. That was really all I wanted to comment.
Okay, cool. Debbie's good too. Awesome. So that's a big thing on loan appraisal. I'd love to kind of throw it around a little bit with what's everybody seeing that's working and winning right now. Obviously, from our perspective, it's speed. For closings, it's being aggressive on low appraisal gaps. It might be waiving financing. So let's talk a little bit about waiving financing. Really the whole point of this restructure is to make sure that we have a plan B in place to know that if X happens, we pivot immediately to Y. Given Jackie's example of maybe a 14, 15-day close, we got that request just last week and we can make it happen. But in this scenario, we got to all be on the same page that, hey, we got to move real quick. So if this comes in, we probably don't have time for an ROV. We just have to have, and if we do want to do an ROV is reconsideration of value, asking the appraiser to reconsider based on, potential comps, things like that. And if we want to do that, then we got to do it extremely quickly because the appraiser has 2 business days to get back to us, regardless of our close date. So that there may or may not be time to do that given our closing date. So this is really important on the structure side. When we go to jumbo, it's really important to make sure that we already have that additional cash accounted for, whether it's going to be a gift or whether it's going to be pulling from an investment. Because remember too, maybe that client has it in, stocks or E-Trade or whatever it might be, and it might take 2-3 days to liquidate. Those are the things that we need to cover up front to make sure that we've got a really solid plan, like immediately when or if that does happen. So I think that's really important. What else is winning out there, you guys? We've had, like I mentioned earlier, we had a scenario where somebody came in really heavy early and got it off the market within 2 days. That was a great move. What else is working? Brooke, you got in?
No, but I have a question. How many times do they do a reevaluation of value where they actually agree? Because I think my understanding is you have to go back to that same appraiser that appraised it low, and they have to agree that
Really
they were
good,
wrong.
really good question. So I've actually had it where they straight up missed a comp. There was like, you know what? I legitimately missed that comp. That is an absolute comp. Let's replace it with this one and brings the value up. I've had it where they say these aren't comparables, and I guess we can talk about comparables a little bit too. I just had an appraisal. It did come in a little bit low. We had an offer in at 975. Appraisal did come in right at 950. However, that client had a $25,000 appraisal gap, so it was a little bit anticipated we might see that. And I went to the appraiser because, based on current market conditions, all that. And they actually went outside of their radius, which is supposed to be within about a mile of the property, to go grab comps that technically probably shouldn't even have been used because they were really trying to get to contract price, which is always what the appraisers try to do, right? Like they're not trying to come in low. They have to have data points because the other thing that happens with appraisals is they get underwritten not only by our company, but they really get underwritten to like Fannie Mae, Freddie Mac, or a jumbo investor like Chase or Citi or all these other guys that we work with, and they have to accept that value too. And the way they accept that value is based on current data points that have closed within the marketplace within that radius. So what happens on these appraisals is they come back with risk scores. They either come back with a 1, 2, 3, 4, or 5, and 4 and 5 are in danger of looking like an overvalued appraisal, which then reflects a little bit poorly on the appraiser. So that is something that we have to be really, really aware of. And to answer your question directly, Brooke, I'd say 1 in 5, 1 in 4, if we actually did a reconsider a value come in accurately. And when we do those ROVs, guys, we really rely on you because you know that market, why you went to that price based on the comps that you saw. So a lot of times we'll go to you directly and say, hey, what'd you see here? Like, do you have a comp that's outside of these 4 or 6 or in some scenarios like 8 comps that an appraiser used? So it's really important to get on the same team there. But yeah, we'll basically send that to you and say, what did you see? Like let's send it back to them. We're all in for it, especially if we have a good comp that they might have missed. But typically when we see an appraisal value get raised, it is because a comp was missed, not because the market deemed it. What else we seen out there? Anybody else have a good win story that might help the group? Jack, you had a good win lately?
Yeah, double-edged sword. I mean, so I did have a good win at the end of last year. There was a condo downtown Belltown, Vine Street, beautiful place, beautiful views, but just, 1,200 bucks a month for the HOAs. So condos and townhomes are just so many of them, hard to move quickly. But they're moving, and the condos, the flat stacks are just really slower, but they are selling. So they will sell if you hang in there. And then we found one similar circumstance only in Bellevue. They loved it. So we did a 1031 into that. I had four cancellations last year. All four are relisting with me now. So, I mean, it's coming back, but I think those are the ones that I worry about pricing. I think the single families, even though they're escalating quickly, I don't worry about those as much. I think, yeah,
Yeah, I
that's
think
my
we
thought. Anyway, I don't know what everybody else, Brooke or, Mark, you guys, what are you seeing? I mean, we were chasing a Broadview property, two Broadview properties, both Ramblers, both beautiful, one on Fourth, one on, I forget where, but just nice places, and they just escalated crazy town.
Yeah, I personally think that, at the end of 2024, we should have seen the bottom of the condo market, or at least the bottom of how long it takes to sell. They just had so many negative things going against that property type, right? You had the exit of city from COVID. You had all the HOAs trying to figure out how to navigate the higher insurance costs. There's just a lot of things that have happened for that condo market. And there's a lot more available than single family. We all know that too. But I do think there's going to be a little bit of I think 24 into 25, you look end of year, December 24 to end of year 25, condos will have a little bit of a rebound. A lot of it has to do with affordability, right? Like if, people are having a tough time and, as a starter home going to 1.2 or 1.3 million. So I think, to that point, Zach, you're seeing a nice place downtown. Maybe that's where somebody starts now. And 3-4 years ago, that might not have been the case. So I've read a lot about the just kind of what we're starting to see a lot of HOAs figure it out. And I think that 24 was a really hard year for them to navigate what was a massive change. And I think we will see better pricing on condos. I think they'll sell a little bit faster this year. I brought this up last year and I wanted to re-bring it up because we have so many good data points now from basically January 2024 to January 2025. A lot of people did not think that we would see the appreciation numbers that we saw in 24. And depending on exactly where you're at, you're somewhere between about 6 and 10%. Now that's the full year. Remember, we talked already a little bit about early in the year, first half of the year, we get a lot of appreciation between January and June, where the back end's a little bit lower. But if you just go year to date, December, January 24 into today, like a lot of markets have had 6, 7%. And I created this last year and I'll give it out to everybody again. But these are a lot of the questions I get from clients and my responses that I use, including tools that I send them. So I think this is a great document to have just kind of on deck and, maybe read through it. And if you've seen, any clients' questions come through here, this is almost like a scripting tool that I've used with our referral partners and I use with clients directly. And a lot of them are really, really direct to questions that we receive. Is it better to buy now with interest rates higher, drop below 6? The answer is there really is never the perfect time to buy, right? And we've got a lot of tools to help them. I'm showing these rent versus own tools a lot. The real estate report card, our home price is going to increase this year. And I'd say historically, absolutely. And then I would go back to 1 year ago and I'd say, we didn't really think we were going to see 6 to 10% in 24 with a high interest rate environment. So given that we're kind of in that same place and there's still a limited number of homes available, I think we can project appreciation again in 2025. So a lot of these things, we're trying to give you ammunition as real estate agents for the client objection questions that we get. And these are a lot of the ones that I've seen. So there's about 10 of them here that I want to send off to everybody. But, one big one that I get a ton is, buying a mortgage is so much more expensive than rent. And in many cases, the client is absolutely correct, but they need to understand the full benefits of being a homeowner, right? One's obviously appreciation. Two is going to be, paying down principal instead of rent every month. Three is going to be tax benefits. And when you add all those things together over a 5-year period, that's why they say you're about 10 times more wealthy as a homeowner than as a renter. So some of these are a little more detailed questions to work through, but we have tools for all this stuff, you guys. So if you get this question in email, if you get this question over the phone, tell that client, hey, we've got some data I want to send you, and then just give us a call and I can put all this stuff together for you so you can have a really detailed, educated response. Because I think that data now more than ever is really, really important to the consumer and for us as professionals to show that we understand this market really well. So I wanted everybody to have this towards the beginning of the year. Again, we did bring it up. I think it was last like June or July. But we have all these different things. And this is the big one that I wanted to bring up too, the bid over asking price. I think that is an awesome tool that we've definitely used a lot in some of these meetings, but remember that we have it. So if that client is going to go 10, 15, 20% over, we can use this tool to show them when home appreciation might catch up if there is a low appraisal to try to offset some of those fears. And I think that's really important for the consumer to understand that if they think they quote unquote overpaid, then they can recover from market appreciation in a very short period of time. And typically that's going to be within about 12 to 18 months. So that's really cool. And then the points question number 8, we've been talking about this for a long time in this higher interest rate environment. I just don't love permanent buy downs because those break evens are about 4 years, and all the data points that we get, we really feel like you're going to see a different environment. And we've already kind of have from last year to this year. We had rates in the 8s at the end of 23, and now we're getting close to under 7 again. So we're already seeing a different environment. We dipped down under 6 in September. So I think the answer to that still is yes. And I do not think that buying points makes a ton of sense right now. I still don't. So all of these objections will get sent out to everybody here. So it's just so they have something to get to and make sure that you understand kind of some of the data points we can help provide to clients that are feeling apprehensive about buying even this year, even though last year we did see the appreciation numbers that we did. The one big one I think that I don't have a direct script for because nobody does is, what does this administration change mean? And I think, we just have to go to our knowledge in the marketplace about what's really happening and how we started this conversation is, we're seeing quite a few homes go well above list price right now. So if you're going purely off of, what the local data looks like, I think that should calm the nerves of a presidential change. And I think that's starting to get a little bit more and more muted as we get more and more months down the line. So that's one thing that I do not have a script for yet, but by April, we should have a pretty good idea of what direction we're going in. And I do think that's going to help a lot. Gardner talked about that a lot at the event we threw a couple weeks ago, is by March, April, we should have a pretty good direction and we should have a better projection on where interest rates go to. So I think the first quarter of the year is going to be a little bit unknown, but by the time we get to April, May, we should have a pretty good idea of what direction we go. I saw estimates, I think it was yesterday, actually, that some economists are already changing the rate prediction from mid-6s down to high 5s again. And that was like a month ago where they changed them from high 5s to mid-6s. So things happen really, really fast. Any questions on these, you guys? Would these help to get sent out to everybody? Yeah, Jack?
Hey, I just wanted to note too, a word on appraisal waivers.
Yeah, absolutely.
So we've been having really great success with getting waivers. So prior to January 1st, the rule was the purchase price had to be beneath 1 million and the down payment had to be a minimum of 20%. So Fannie Mae and Freddie Mac changed it January 1st to also allow waivers when there is 10% down. So unfortunately, they did not raise the ceiling of 1 million for a purchase price. So we're still stuck with that. But frequently we are getting these waivers. So that's exciting. And we'll even go so far as to check for a waiver prior to an offer, which can really be a huge advantage when you're presenting to a listing agent to say, because even if you're waiving financing, correct me if I'm wrong, as a listing agent, you still worry a little bit about the appraisal. right? So if you can go in and say, hey, my offer is X, and I already know I've got an appraisal waiver by lender who's already, clarified that, then that could end up being a great win if you're close and competing with numbers, right? So anyway, wanted to bring that point up, that the waivers are a real thing. We will never get a waiver on new construction because there's no history of the property. Because Fannie Mae and Freddie Mac are pulling data points from their big bank of value information. That's how the waivers are arrived at. The new construction is going to fall outside of those boundaries. But anyway, so that's always fun.
Yeah, huge point. Everybody heard that, right? Chris Braxton, did you hear that one? Yeah.
Yeah, I heard it, but I just typed into the chat. I've been out of the business for a few years, and I haven't heard of waivers before. Can you, if it's not a waste of time for everybody, can you tell me briefly how they work?
Yeah, absolutely. So appraisal waiver, like Jackie just mentioned, it's with at least 10% down on a typically conventional loan only. So that'd be your Fannie Mae, Freddie Mac loans. And the purchase price cannot be more than $1 million on your offer to get a waiver. That is a Fannie Mae, Freddie Mac rule just because of the high value of that property. They want to make sure that somebody gets in there and takes a look at it. But typically what they'll do is they'll look at surrounding data points for sales in the area of that listing. And if there's enough data to support your, escalation offer price, then sometimes you won't need an appraisal, which is obviously cost saving for the client, a huge relief for the real estate agents too. And what Jackie was mentioning is that's something that we could do before we even submit the offer in that scenario where you have at least 10% down, owner occupied, going underneath $1 million purchase price. So that's something that can certainly help get an offer accepted if we can come in and say, hey, we're going to 850. We got 15% down. We already got an appraisal waiver. That listing agent, like Jackie was mentioning, is even if they, even if we have a waive financing client, that brings a lot of relief to the transaction. And maybe that's something. If we're 850, somebody else is 850, maybe that wins the deal. Or maybe if we're 830 and they're 850, that wins the deal. So typically up to 999,000 with at least 10% down, owner occupied on Fannie Mae and Freddie Mac loans. That's where you'll get a potential waiver.
Okay. All right. Thanks for the explanation. I appreciate it.
Yeah, absolutely. Anytime you're doing a government loan, FHA or VA, you're going to need an appraisal. Let's touch on FHA real quick too, and VA, because they're kind of similar with their requirements. They're just a little more strict on the safety of a property, and they're going to take a look at the crawl space. They're going to take a look at the attic to make sure that nothing seems wompy or they've got water damage or something like that. They're just a little more strict on the safety of a home. And that might mean they're a little more stringent on guardrails on a deck or handrails on a staircase, things like that. So they're the same appraisers that actually do your jumbo and do your conventional loans. They just have to follow stricter guidelines for the government-backed loans. The other thing with government-backed loans, as a refresher too, is anytime you have one of those government-backed loans, the seller has to sign what's called an amendatory clause that basically acknowledges that they are selling their property to a buyer that's getting a government loan. So why that's important is because that will have to match whatever price the appraisal comes in at. And basically everybody's acknowledging that the appraisal came in at X value and the seller has to sign off on that. So, this is a little bit murky because if you've got a really good VA client that's going to $1 million, for example, and the appraisal comes in at 950, technically that amendatory clause would supersede the contract and say that client doesn't have to pay $1 million for this property. They only have to pay 950. Now, the way and why I say this is a little bit gray, because I've had VA clients that have said, we don't care if it comes in low, we're going to pay for it. Then they've written letters to the seller telling them that. But technically, from a legality standpoint, they have another out. So we've got to all kind of communicate with the listing agent and make sure the client's being over communicative that even if we have a low appraisal, it's not going to kill the deal. And that doesn't mean that they can't still pay $1 million. If it came in at 950, they can still do that. They just have to acknowledge that it did come in a little bit low and they're still okay moving forward. So that one's really important if you got a VA client. FHA is a little bit different on that one, but the VA's got a very strong out for it. So wanted to bring that point up if anybody's got government-backed clients, because that's something that could get tripped up. Technically that should go in with the initial offer, but to be honest, a lot of times we'll get that amendatory clause signed after the appraisal comes in, when everybody knows what that value looks like. But from an offer writing standpoint, I think it should be going in at offer submission. Let's see, what else do I have? So this one is, and I guess let's talk about low down payment options in general. As a reminder, conventional can go to 3%. So one question I always get from clients is, I'm going FHA, I got a low down payment. I'm like, well, cool, why? Well, I've heard that FHA is the only low down payment option. It is not. You can go 3% down conventional, and now with a loan ceiling increase, they can go all the way up to low 800,000s with 3% down on conventional and still qualify. Why that's so important as a reminder to everybody is you don't have the finance mortgage insurance premium on conventional that you do on FHA. So technically, it's more inexpensive to go conventional over FHA, even though you might get a slightly better interest rate because you're not paying the 8,400 to finance, and your PMI is probably more inexpensive on conventional than it is on FHA. So just a really quick refresh for everybody out there too, that might have first-time home buyers or low down payment options. So I think that's important to note too. I wanted to bring this scenario up as well because it's very current for me. I'm working with a client right now that is slightly less credit. So they're looking at slightly higher interest. We're looking at 3 options for them. And I wanted to bring this up because this is something that's getting a little bit more popular. This client really wants to do renovations to their property. So cash to close is extremely important to them. As soon as they move in, they want to do something. So the first thing they ask me is, can we finance our closing costs? And that answer is no. You can't finance closing costs into a purchase of a traditional conventional loan. So what we've decided to do is take a look at slightly higher interest rates for potential lender credits. So first, let's look at the difference in monthly payments. So if we had a 7.187 interest rate, that's 48.26. 7.312 is not much different at 48.86, only $60 more a month. However, we can offer them $4,000 in lender credits for the very small increase in monthly payment. And the client loved it. We're like, yeah, we're basically getting $4,000 for $60 a month. I was like, yeah, that's exactly what's happening here. So we went up a little bit further. Said, okay, 49.47, that's about $120 difference a month. And we can give you roughly $6,200 in lender credits. So they also got $5,000 in seller credits because it was an offer that their agent said, okay, we'll go a little higher in price and we'll just do a little bit of seller credit to go with it. So in this scenario, they're going to option to get $11,200 in credits and only come to closing with $1,500 more than their down payment, and they're ecstatic. So now they're going with 127 for their total cash to close instead of 133, which is going to allow them to redo their bathroom instead of bring the additional cash to close to only save about $110 in monthly payment. So I wanted to bring this up too, because guess what else you could use this potential lender credit for? Buyer brokerage services agreement, right? So let's say you've got a 3% BBSA and the seller says we're only paying 2.5%, and you do want to potentially have your client pay your full commission, or maybe they're offering 2 and you'll settle at 2.25%, 2.5%, something along those lines. Well, this is a way that the client can finance slightly more on a monthly basis to potentially get $6,000 in this scenario because we've got a loan amount over $700,000. So for only $120 a month, the lender can then offset their closing costs by $6,200, which might then just get paid to you guys. And I bring this up because I just had a closing in Shoreline in December that did just this. And it is out there. It is a tough thing to potentially, talk to the client about and, make sure that we're getting paid, but we want to try to protect your commissions too. So I think this is really important to note that for a very small increase in monthly payment, we can give a pretty sizable credit to the client to try and help you guys get full commissions, or at least more commissions than what the seller is offering. So this is something that I want you to keep in mind if this scenario comes up. So questions around that one? No? Let's see. I don't see any hands up. Brooks, that makes sense? Yeah? Everybody good? Jack, you got that? Cool. All right. Last thing I wanted to bring up today, and obviously we'll take any questions that anybody's seen out there is I brought this up last year too, and the only reason I'm bringing it up again is this is working really, really well. So this is my call strategy for real estate agents that I use a lot with clients, especially clients that I haven't talked to in a while. And it's always really hard to break the ice with somebody that you haven't had a communication with for a year or two. And Jack, this is something I learned in the core, so this is something you might already have. But again, it's just kind of a call strategy, introduction, tell them who you are. The biggest thing to note is that number 2 box. The reason for my call is, and why that's so important is it gives the call direction really early and there's no dead air. So as soon as you say, the reason for my call is, we met at an open house 6 months ago, and I just haven't had a chance to follow up with you in a while. I wonder if you're still out in the market. And then really important to pause and let them make that second move. No, I'm not in the market anymore. I rented for 6 more months. Okay, great. Do you mind if I reach out to you in July to see if you've changed your mind about buying a house in the back half of the year? So I think this is a really important thing to use structure with. 1, introduction. 2, the reason for my call is, and then you have a strategy. You can go to any one of these boxes. And the reason why they're in boxes is you might not have talked to one of your pre-approved clients for a while. You might not have talked to a lead for a while. You might not have talked to, a client that you did a deal with 2 years ago for a while. Or maybe it's just, you don't know what to say, so you invite them to something. The reason for these 4 boxes is anytime that you're about to make a call to somebody that you do not know what to say, you have options here in these 4 boxes that you can go to immediately. So, Greenwood does a really good job of setting up things throughout the year, whether it's shred events or whether it's the, June party with the old cars. Maybe you're just inviting people to that already, or maybe you've got, your personal client stuff that you're doing. All those are great for clients that you've, done transactions with over the last 5 to 6 years. But maybe it's talking about the Windermere Ready program for somebody that didn't know it existed. Maybe they wanted to buy that, or maybe they wanted to sell and they don't have money to do that. Maybe they want to buy before they sell. You can talk about being a real estate agent. I want to talk about this all the time, but it's such a good one. Maybe they've heard about the NAR updates and you want to give them a brief 30-second picture on what it really means. But really the whole point to this document is to try and get them with a yes or no question of, can we meet to discuss? Maybe it's the current market, or can we meet to discuss, maybe it's the loan program that you used for a past client. Maybe you tell a story. So the whole point of this document is to give you guys opportunities to make the phone calls that are challenging, or make the phone calls that you're not feeling super comfortable making right now. So hopefully this helps too. But this is something that I use with my clients that I've done loans for in the past, and I've found a lot of success with it. So I built it for you guys and added some updates from last year too. So hopefully this is something that you can use here in the first quarter or throughout the year. Keep it on your desk, keep it in your folder, and it's in Word. So make the edits that you want, that you're comfortable with, so that we can, use it well. But I think this is a really great tool to use. So anybody feel like they could use this, I'd be happy to send it out to them as well. That's what I had, you guys.
Hey, Jim.
Yeah.
Really quickly, with the interest rates being higher, what would you suggest as far as refinancing? Because I did have that come up at one point where they were like, I mean, is there some kind of like a graph or a program or something that can kind of advise them? We're always saying you're not married to your interest rate, but
Yeah, the really easy math is if you're under a $500,000 loan, it's
mhm.
about 0.75%. If it's over 750, then it's about 0.5%. My personal math is always 0.75 to 1% though, just because I think 0.5 is a little bit light. But even like, let's look at last year, right? We started the year probably about 8%. By the time we got to September, it got to about 6, and now we're back closer to 7. So I think the message back to the consumer is, there is going to be an opportunity sometime in the next couple of years. I think that you need to get to at least 0.5 to 0.75% lower to make it make sense. And like Movement, for example, will offset bank costs and lender credits to refinance to keep clients as in the servicing department, because that's how our company is built. It's really important to keep clients for a long time. And the real thing is, I think you're going to see a change, right? The Fed has already pointed to we're going to do lower rates. I know yesterday they decided they're going to keep it the same, but that wasn't a surprise. So I think when you're talking about refinancing in general, you can give them those general numbers, 0.5 to 0.75%. And anytime a client asks what the costs look like, you can say it's about half the cost of purchase. So if they look at their closing cost from their loan purchase, they can cut it basically in half. And if they worked with us, then we'll offset some lender credits. So typically we're seeing refinances when we did a few of them in September, about $2,500 in cost. So it's relatively inexpensive, which makes the break evens like 6 months down the road, which makes it make a lot of sense.
Great. Thanks.
Yeah. Anything else, team? Jack, what you got? You always got something. Chris, yes, we do have loan programs for teachers, EMS, police. We Movement will give credits for those first responders to help offset closing costs. And then there's also down payment assistance programs with the state. And we have one that's called a Movement Boost program that gives about 3.5% on the FHA side too. So lots of stuff out there for first responders and stuff that we have as a company, and then stuff that the state has too. So lots of programs around there. Yeah. And I will definitely get the sheets out to everybody too, so that they can have those. And then sorry I didn't have the chat box up, Chris. Thanks for reaching out.
Hey, Jim, do you have a minute when this is
Yeah.
over to talk about your teacher loan programs?
For sure, man. Yeah.
Okay, great.
I will, if you're okay, I'll give you a call at about 12:15 if you're going to be available.
Yeah, that should work out great.
Cool. Let's do that. Anything else, guys? I'll stop recording here too, so we can do that. But let's see.